Welcome, everyone, to How to Retire on Time. I'm Michael Decker here with David Franson. As always, this show is about answering your retirement questions, not that oversimplified crap that you get online. No, we want to get into the nitty-gritty here. It's all about the details. Submit your questions here. We got a live feed. You can put your questions into the chat or at any time go to retireontime.com/ask to submit your questions throughout the week. You know that moment you're driving in the car? Okay, maybe not driving in the car and texting and driving, but you're at home, you're thinking about stuff, you're at work,
All right.
and you're like, I want that one question. retireontime.com/ask, submit it, catch the show live on Tuesdays, on the weekends, on the radio, or on YouTube. We post the show and everything through podcast and YouTube as well. Let's have a good time today. So today's theme is about risk. So as the polls are coming in for kind of what everyone wants to talk about today, as the questions are filling in the chat, we're going to talk about risk. I think it's one of the most fundamentally misunderstood parts of finance.
Yeah. So why do you say that? What makes it so misunderstood, I wonder?
Well, okay. If you take on more risk, what do you get?
Well, the old saying goes, more risk, more reward, right?
Yeah. That's the problem.
So we're thinking like, oh, well, I'm guaranteed to get more reward, or I won't get any reward unless I take a lot of risk.
It means that you can take it on the chin over and over and over again, and you're still going to be better off. Maybe. Maybe.
Yeah.
I'll use the classic example of Cisco in the late 90s was one of the best stocks you could have bought. And that was risk you were taking. You were taking that the price was going to keep increasing, and then it didn't. And then it tanked like over 80%. And it took 25 years to return.
Wow.
So do you really want to be sitting in that risk threshold? So this is where risk becomes a bit more nuanced, a bit more complicated. And I really want to break it down because the thing I keep hearing today, frankly, is these assertions that I'm comfortable with risk. No, you're not. I know you're not. We've had these conversations. You're comfortable with more reward.
Yeah.
And who isn't?
Right.
I hear the conversations, and maybe, anyone listening here would have said this. Things like, well, I don't need to touch the Roth for 20 years, so let's put additional risk in there because I can withhold it. It's like 80% true what their intention is, but I think it's misguided because it lacks context. Okay?
Okay.
Let's do a few examples. I tried to kind of come up with an analogy here for a second. So let me know if this works.
All right.
And say in the chat if you appreciate this or not. But risk doesn't mean reward. More risk means more growth potential. There's always two sides to that equation. Okay? So anytime you're driving, you're taking risk.
All right.
Right? Have you ever been T-boned or hit?
I haven't. I've been hit, but not T-boned.
Okay.
Yeah. Thankfully.
How was that?
I mean, it's
Was it aggressive or was it like a little tap?
No, there have been a couple. There have been some taps and there have been some more aggressive ones, but
Okay.
it's not a fun experience either way.
You're an unlucky driver if you've been hit a couple of times.
It's been a while. I mean, this was in my younger days.
Oh, younger, more vulnerable days.
Yeah.
So let's take the example of the classic stoplight. A great invention, right? We've got green light, yellow light, red light.
Yeah.
Every time you go through that green light, you are still taking risk. Someone could T-bone you. Now, the risk is inherently lower. When you go to a yellow light, you're increasing your risk. Now, for this analogy to work, let's say that everyone goes to a yellow light. So in some countries, they say like your yellow light's like, get ready, you're going to go. And other ones just shut off. So let's say that everyone gets to a yellow light and then it switches. So red, yellow, green, and green, red, or yellow, red, right? That yellow light, that's the cautionary bit. There's increased risk of what you're going to do. And I see this all the time. Someone's like in the middle of the intersection, right? They're going to take a left. It's yellow. Oh, they can go. But the other person who's coming down wants to speed and hit the yellow. So they're going to speed up and going through the intersection, not realizing the person's in the middle taking the turn, and then they hit each other. And that happens a lot.
I've been in that exact situation.
Which one were you? Maybe you shouldn't say for your insurance provider.
It was a while ago, but
that's a risk.
Yeah.
Okay. Now let me give you another risk. Running a red light. A lot more people have run red lights than they want to admit.
Yeah.
It happens. I mean, how do you think the person going through the green light, that was increased risk? But in theory, you could, let's say it's 2:00 in the morning, just go through a red light and there's lower risk, but there's still risk.
Yeah.
My point being is you cannot drive and have no risk.
Right.
There's elevated environmental levels of risk. Let's use another analogy. I went recently deep sea fishing out of Aruba. I've been on the ocean many times. Usually, I don't get sick.
Okay.
This season, the swells were, 6, 7, 8 feet. There was an increased risk of getting seasick because the conditions were different. Plus, the fish at that moment had a decreased level of seasonality, whatever that means. People say, oh, well, they're in season here. I don't really know fishing. I just know I like to get the charter bit and I like to catch the fish and someone else does it for me. They know the hard parts. So in that experience, I went deep sea fishing. I fed the ocean several times. And we caught no fish. The theme I'm trying to make here is risk has an environmental component. And we need to acknowledge that. In 2010, the good old days.
Oh, yeah.
Okay, we just had gone through the great financial crisis, a horrible recession, depression, whatever you want to call it. People have different definitions. It seems like the definitions are changing. And now we've got treasury rates low. The market is primed for cheap money. We've gotten through that financial crisis, and the conditions are perfect for growth. That's a very different condition than 1999, where we've already experienced significant growth. Do you see there's an environmental factor here? So it's not just saying, I want to increase my risk arbitrarily. It's, I'm okay with increasing risk. What does the environment tell me?
Yes.
And I don't hear this conversation because usually what I see people doing is they're either in the market or they're in cash. That's a tactical model, which is very difficult to do and many times can fail. Because the markets are going down, you go to cash, and then it jumps back up because of some tweet or something like that, and everything's fine, and you miss that opportunity. Or there's the static model of we have no idea what the markets will actually do, but this is the questionnaire you filled out for a static allocation to this sleeve and this much in stocks and that much in bond funds and blah, blah, blah. And that's just the averaging of everything and saying, all right, this is what we're going to do, and never question it.
Yeah. So yes. Oh, you have this diversification here, and we never change it. It's just this is what it is all the time.
Because that's your risk suitability. Who cares about your risk? It's important to understand risk suitability.
Okay.
But who cares about your feelings when the whole process lacks to acknowledge the current economic conditions? It's like, are you comfortable with being warm, like really, really hot outside? Some people are fine with it. Some people are not. Now let's ask, is it summer or winter?
Yeah.
Those questions need to go together, and yet so often we only ask one and not the other. Here's my point. Right now we know the markets are pretty high. They're pretty expensive. That is an economic fact. Right now we know that we've had incredible growth over the past couple of years, a lot of that due to the printing of lots of money. So we've manipulated the money supply. That led to a lot of inflation, and inflation favors the wealthy. That's why the stock market has had incredible returns for the past couple of years, plus AI. So we printed a lot of money, and then it went to AI, and there's this new technology everyone wants a part of. So there are several key canaries in the coal mine that say, yeah, it's been really, really great. But how great can this gravy train keep going? Now, I'm not saying that people should go all in bond funds and hide under a rock, and I'm not saying that at all. What I'm saying is arbitrarily managing a portfolio based on sentiment ignores risk conditions. Arbitrarily having a portfolio that's your plan with a rule of thumb withdrawal rate for anyone that's retired or within 5 years of retirement kind of ignores several factors of what risk actually is. Because risk, in the most basic form, is the willingness to put some money into something with upside potential, but being okay with the downside exposure. In the short timeline, in retirement at least, you cannot afford to take high risk. because if you get it wrong, you're accentuating those losses. So this is the time component. 1, we have the conditions. 2, we have the time. When do you need the money? It's appropriate to put something in a model or some sort of system that is measuring risk today, but you don't need to touch the money for 10 plus years, while you have other money that may be laddered out. Maybe your first year of retirement comes from a CD. Maybe your first year of retirement comes from that treasury ladder you put together. Maybe it's from a MYGA. Maybe you're retiring in 5 years and you bought a fixed index annuity that's liquid in 5 years, and you're going to take that for the first 2 years or something like that. Do you see how risk is not only a time spectrum? Do you have enough time to ride out the risk that you're taking? But also it's a conversation of, when you need the money and the current conditions. And current conditions, let me be specific about that. There's the bond market. Look at the 10-year treasury. Is it high? Is it low? That's going to affect the low-risk environment that you can take. And if the low-risk environment is appealing, more money might sit there. If it's a bad deal, more money might try to go into real estate or might try to go to the stock market because it's trying to look for a good deal. You've got the stock market and its current valuations. And is it a good deal? Is it not? There's so many factors here. Inflation, tax rates. How do you get money out of one thing to the other? That can inhibit people from wanting to make various decisions, which then has a conversation about liquidity. And I can keep going on and on and on and on and on. But the point being is risk is not an arbitrary thing that you sign up for without understanding your conditions. You don't say, I don't need sunscreen. I can just be fine and know it's a cloudy, rainy day or it's a cold day. It's disconnected. And I think a lot of people don't understand risk because the past experiences over the last 5 and even 15 years have basically said the more risk, the more reward. And that is deceptive because that allows us to willfully ignore past performance isn't indicative of future returns. It's like, oh, I know they say that, but wink, wink, nudge, nudge.
Yeah, right.
We're going to kill it again.
So much like if we're getting dressed in the morning, we want to check what the conditions are outside. That'll determine what we put on.
Yeah.
So if that analogy stretches, if I'm hearing you right, to the market, like what are the conditions in the market, and that'll depend on where I'm going to invest my money.
Yeah, and this is us here at Kedrick Wealth, not trying to drive fear into anyone. Frankly, our model right now, and maybe we'll talk about our model a little bit. Our model says risk on, we're good. I'm trying to have the conversation now so that later it's not a, oops, no one told me.
Right.
I have conversations with financial advisors all the time. And you know what most of them don't know? That the markets can go flat for 10 plus years. So all of the DIY investors, the self-managed investors, where they're going, this is great, have no idea that the historical conditions suggest that the next 10 years have a total return of 3% based on historical averages and the CAPE ratio, which is a pretty good metric. It's been pretty accurate for, 100 plus years.
Okay.
No one knows that.
Yeah.
Do you want to take the risk that suggests, again, by these historical measurements, that you might get a total return of 3%? Or do you want a system that says, risk on, risk off? Let's dial it up and let's dial it down. Not static allocation, not time the market, and not I'm in and I'm going to take it on the chin. What if there's a more methodical system? That's all I'm suggesting here.
All right.
So because we brought it, let me talk about this first. We'll talk about the model. So
Okay.
my thesis was pretty simple. When I said, what could we do? It's really hard to beat the S&P year over year. That is true. And I wanted a model that said, hey, if the S&P says go, risk on, if the model says risk on, if the indicators say risk on, I have no problem with a self-managed individual going mostly in the S&P 500. That's a great growth strategy. And anyone that says otherwise is just jealous. It's almost like we're paid to convince you to do something that's in your best interest. No, it is a good thing to do, especially in your working years. There's nothing wrong with it. Let's not criticize that strategy.
The strategy of just sort of buying an index fund and holding it, or
Yeah, what's wrong with that?
yeah,
I know it's like our job to try and convince people to do more fancy, complicated things. But that's kind of a conversation to convince people to pay people money when you could do a lot of it yourself. Like you're within striking distance, if not beating people during the good years. The problem, though, is that assumes you're driving, in that driving analogy, and you're only going to get green lights. Maybe a couple of yellows, but you blew through them, no red lights. That assumes in my fishing analogy that the seas are always going to be calm.
Oh, right.
We know that's not always the case. And so to me, I prefer that ability of having a system that says yellow light, just be aware, or red light, this is going to get pretty ugly, or at least it looks like it's going to get pretty ugly. Let's start tapering it down a little bit. And then when the time is right, let's buy the dip. That's all I'm suggesting.
Okay.
And the only way to really do this, because you can't time the market perfectly, no one can. There's no such thing as a perfect investment product or strategy, is to stop looking for products. It's like the retirement space and your Instagram feed has taught you to say, I've got a lump of money, I need to arbitrarily buy this product and that product and that product and this product, and they're all going to kind of do their own little thing, and it just kind of is going to work itself out. That's like going to the grocery store and buying a bunch of random ingredients and then going home and then starting to figure out, okay, what can I make with this?
Yeah.
And I'm pretty sure fish oil doesn't go with most other ingredients. Like that's a weird one to cook with.
Pretty specific.
Top ramen probably isn't a good thing to cook with if you've got, I don't know, ingredients for beef Wellington.
Yeah.
I'm making stuff up here, but you
Yeah.
get the idea. So here is the secret. It's not even a secret. It's the sequence that a lot of people get wrong because there's an inherent distrust in financial services because everyone's trying to sell a product. It's to put your plan together first. This is how you get rid of the product pitches and the biases and figure out what's right for you. Put your plan together first. When you have your general projections that are reasonable, then you can start to say, okay, do the numbers work out under these inflationary factors, under this, under that, and so on. And then you start figuring out your efficiencies.
Okay.
How do you get more out of your money? Maybe one of the questions today will be on that, but how do you get more out of your money?
So the plan could be, I want to travel, I don't know, whatever, 8 weeks out of the year. And then so how much is that going to cost?
Yeah.
And then you throw all those other things in. And
Yeah.
is this sustainable? Does this work?
Yeah, and that's kind of it. I mean, let's just do a quick example. Let's say we've got a couple here that they're both born in 1966. Okay, they're retiring soon. All is well, and they want 120,000 out of their, well, let's say 150,000 for fun. Okay, 150,000 they want out of their IRA assets because they need to spend money somehow, and they're not filing for Social Security yet.
Okay.
Okay, that could work. And you could buy an income annuity and you got that kind of income stream. You could buy a stock bond fund portfolio in your IRA and you could take that in there and you're like, oh, well, I don't want to have RMD issues. And so let's do that. Or you could say, well, what if I only took 50,000 out of my IRA? Oh, by the way, if we assumed Arizona state tax, 150,000 gross income, it's going to be around, assuming the standard deduction, it's going to be around 20,000 in taxes. But let's do 50,000, let's say, and then we're going to take out some of their brokerage funds that they didn't think they were going to touch for a while. It's kind of their fund. Maybe there's 20,000 in gains in that, and the rest of it is basis they're taking out. That 20,000 tax bill just went to 3,200.
From 20,000 to 3,200. All by shifting like where they're taking the money from.
Just looking at strategies.
Yeah.
Now notice there was no conversation about a product here.
No.
And I'm just doing this on the fly with our tax calculator. But when you know what you have in the pre-tax, after-tax, and taxable account, okay, and you understand the seasonality or the strategies that will be available to you, maybe you're going to retire at 62 years old. You're not going to take Social Security yet, so there's a golden opportunity. I forget where that's from, golden opportunity. It sounds like a Disney movie or something, but a golden opportunity here that you could tap into brokerage funds, maybe blend different income streams, maybe lower your tax rate, which means more money stays into your account, which helps for future spending or future legacy. And we're even peppering in there your Affordable Care Act subsidies all at the same time. That could be like a $20,000, $30,000 savings in just 1 year. No products were talked about. Because if you say, oh, I want that annuity here, and we're going to do that real estate deal here, and we're going to do that there, you're piling on tax burdens. And then once you've bought them all, a lot of times you can't change it. A lot of these assets are illiquid, and they're going to keep paying you, and it's going to show up in your 1040, and you're losing out all these like tens of thousands of dollars each year of efficiencies because you bought products and you didn't start with a plan and then go to strategies second. Because the strategies determine then the tools in your toolbox, the proper investments and products that you need. To do something like this, maybe the 2 years before, you start putting all of your savings into buffered ETFs that have upside potential, but a lot of downside hedging, taxes, long-term capital gains. You're shoring up a amount of a couple of years that's going to be incredibly tax efficient. This is, I don't know why, but these are the conversations that don't happen. When people go through our planning process, they're going, oh my gosh. Because you have to have strategies second. How do you get more out of your money? And then it's the right investments and products. Maybe for them, they're very concerned about income, and they're going to retire at 62 in this example, and they're going to file for Social Security at 67. Maybe at 67 is when they want that lifetime income stream because that's what emotionally gives them permission to live. And we just need to ladder out some income from tax-efficient strategies for a couple of years, low risk, very tax-efficient. Everything is solved. I mean, this is kind of the conversation that needs to be had.
Yeah.
That's not. That's all I'm getting at.
Right.
Did I miss something, David? What do you think?
No, I think we got it. It's such an important, you have to go in that order, right? If you get that order mixed up, then you could be paying more than you have to, was what I take away from that.
Yeah.
Or maybe if you get the order wrong, maybe you think, oh, I can't retire yet. But in reality, no, look, you really can.
Yeah.
But
We see that over and over and over again.
That's
I don't
nice.
think I can retire for XYZ reason. And it's usually some article they read online. They did some calculations in Excel, and they didn't know the strategies that were available to them. I can't tell you how many people don't retire until 65 because they don't know how to handle Affordable Care Act insurance.
Oh, right.
And the tax efficiencies. And they put this arbitrary cost when they could afford it. And now they're basically saying that their time is not as valuable as trying to save $10,000 a year when they could afford it. I mean, how much of your life how much is it really worth?
Right.
Can you put a price on your time? 10 to 20,000, depending on single or couple, and you could afford it?
Yeah.
Just these are deep questions to ask. So for everyone listening in right now, if you want to go through what we believe is to be a proper planning process, you go to retireontime.com, click the button that says talk to a planner, and schedule a 30-minute call with me or the team. It's real simple. The call is going to ask you, what do you want your retirement to look like? Are you retired? Are you getting close? We just need some context. Do you want to travel? Do you want to front load the income? Do you not? Are there legacy intentions? Kids? We need to know what you want, and then you tell us what you want from us, the financial professionals, whether it's a one-time plan, teach you how to fish, you want an ongoing relationship, or something in the middle. We've got a lot of options there. But our job as fiduciaries is to do what's in your best interest. That starts with you telling us what you want. If it makes sense, we then proceed, start the planning process, and you get the first 2 planning sessions for free. Okay?
Yeah.
Because financial planning is very abstract. You really don't know what you're getting into, like all of the cool things that could be done until you see it. I mean, it's like when I hear surgery, oh, I'm going to get a procedure, a surgery.
Yeah.
Okay. But what actually goes into that? I mean, they've got all these tools and weird things, and like a doctor would know that.
Yeah.
We don't have a clue.
No.
Very technical. Financial planning is surgery on your finances to help you get the most out of it. And until you see it, it's hard to fully grasp the abstract nature of all the different variables that are at your disposal to help you get more of your money. Go to retireontime.com, click Talk to a Planner. It's a great way to start. You get two sessions for free to see what that looks like before you have to make an actual decision if you want to keep going or not. And it's okay either way.
Yeah.
No hard feelings. All right. We got questions popping in here. Let's just take it one at a time, shall we?
That sounds good.
All right. So the first one here is from Scott. He's asking about sequence of returns risk, especially retiring in the early 50s.
Oh, like your age, early 50s, not retiring in the 1950s?
Yeah, I'm
that
assuming.
was a different thing.
Yeah. So there's a really cool thing happening right now called the FIRE movement.
Oh yeah,
I don't think we've talked about it before on the
there's
show.
that financial independence, retire early. Or
Yeah.
something. Yeah.
Yeah.
I've seen them on YouTube.
Everyone loves a good acronym.
Yeah, it works well too.
So FIRE is wonderful because it prioritizes people's time over trying to become the richest person in the graveyard.
Right.
The part that hangs me up a little bit is the longevity risk. And you can't really, like, let's say, go buy an income annuity in your 50s and hedge against that longevity risk. 'Cause that's a different equation. You buy it in your 60s, that's different. If you're in your 50s, you could take IRA funds, buy an annuity, and turn it on. But I don't know insurance companies are going to pay you a reasonable rate for the rest of your life.
Yeah, that's a lot of life to pay.
That's a lot of life to pay. So you have to, in my opinion, be very growth oriented. Here is how I like to see it typically done. Now, these are broad brushes, okay? So don't go home and just do this.
Okay. Yep.
That's why the planning process exists, because there's a number of factors. But one, ask yourself, is it you or do you have a spouse? If you're married, you're going to handle this differently if it's your individual, okay? If you're married, you might want to have some sort of form of life insurance, whether it's term life insurance or indexed universal life, in case you were to pass sooner than, let's say, 65, because the surviving spouse gets a massive bump from the death benefit. That helps hedge against longevity risk, okay? Because you're not getting 2 Social Securities. You're retiring early, and you planned on 2 Social Securities, and now you're only going to get 1. So there's certain longevity factors just to be aware of, and you can get term pretty cheap, all things considered, if you're in your 50s, to get you closer to, 65 or so.
Yeah.
Just a thought. But assuming, let's say you're by yourself, okay, you've got to first navigate the rule of 55. The rule of 55 says if you retire after the age of 55 or so, you can tap into your 401k as long as the funds are still in your 401k. As long as the funds are still in your 401k at the time you retire and you don't roll into an IRA, you can take it out without that 10% penalty.
Oh, right.
Okay.
It'll still count as income, but they don't tack on that.
But the problem is a lot of these 401ks are heavily restrictive. You can't do proper investment picking, in my opinion, in most 401ks because they have like the target fund here and an arbitrary mutual fund here, and that's kind of it. So I've joked with some people, get a job right before you want to retire with someone that has a 401k with a brokerage link, which then gives you basically full access to what you could buy publicly traded.
Oh.
So, you could do buffered ETFs in here. You could do all sorts of other things. That's going to help you have more investment options than a restrictive 401k. So you're kind of setting yourself up to keep funds in your 401k and then pick the right investments.
All right.
It's very difficult to maintain retirement with most 401k options, at least in my opinion.
Yeah, because you get this menu that's very abbreviated, right? Of just these mutual funds
And then here's the first part. I call them the reserves. This is what I talk about in the book, How to Retire on Time, specifically in chapter 4. You need to have something that has growth potential, that has more growth potential than bond funds or CDs, but has very little, if not no, downside risk. Very few buffered ETFs offer this. You probably can't use indexed annuities to do this. You're operating within a very restrictive kind of few investment options in your 401k to generate your income. But you could do it. To get rid of sequence of returns risk, you need to have, let's say for easy math, half your portfolio that can't lose money and the other half that can but has more growth potential. Now, this is essentially the 4% rule reinvented. The 4% rule said 50% bond funds, 50% stocks, take out 4%, you should be fine. Well, if you're 50 or early 50s or so, let's say 55 years old, and you can operate within the rule of 55, 50% maybe in buffered ETFs, where maybe more than half of that allocation is in ones that can't lose money, and then the other half, or the other part of it, has maybe more upside potential, then you got this long-term stocks. Because it's this simple. I said all of that to give you the trick here.
All right.
If markets go down and you have assets that are protected, that can't lose money, you just take income from those assets and let your other accounts recover. That's how you solve sequence of returns risk. That's it.
Seems fairly simple.
It's simple, but it's very difficult to execute.
Because
it's in the moment. And you're going to probably second guess, is this still going to work?
Oh, yeah.
When you see half your portfolio going down 30, 40%,
Oh,
Now your overall portfolio might be down like 25% or so
yeah.
of your life savings that has to last. You can tell yourself, oh, markets have always recovered, but you don't know how long until it starts recovering.
Yeah.
And you start getting mind games.
That would be tough.
It is tough. You have to follow systems and not sentiment. But just like a city has a reservoir of water in case of a drought, if you have a significant portion, and the day you retire is probably the most you want in your reserves, if you have a portion of your assets that can't lose money, so that you can take income from that source while your other accounts that are down have time to recover, that's kind of how you can solve sequence of returns risk in a very dynamic way. Now, should you just arbitrarily do that portfolio strategy? Absolutely not. You're going to want to hedge different bets. You're going to want to look at the tax planning. You're going to want to segment the how do you take income from the day you retire to 60 years old, and then 60 to 65, and then 65 to 75, and so on and so forth. Have different seasons and different methodologies and have different backup plans. It's a very complicated plan, but I love helping people retire early because they get more time, their most precious asset. It's just different. You're using different strategies. And there's other tax code in here. We talked about the rule of 55. You've got 72T, you've got 72Q. 72 is the line of the tax code, by the way, that talks about when you take money out of an IRA, what you can and can't do.
Oh, okay.
A lot of it's misunderstood.
Yes.
But Scott, and to all those who want to retire early, the answer is you can. As long as you've saved enough, you can live within your means. And there's a system in place to solve sequence of returns risk. And one quick, I guess, cautionary tale. I know there are ETFs out there that pay a great cover call income. I know there are real estate deals paying 9+% in quote unquote income. Just remember, they pay until they don't. And when they don't if you haven't prepared for it, you are in a tough spot.
Right.
And you don't want to be there. Real estate, for example, a lot of these deals are callable. They're going to pay you 9% until the rates shift. Let's say interest rates go down, they can reissue, and they can pay 6% to new issues. So they're going to give you your money back, and they don't need to pay you that 9% anymore. They're going to pay you 6% now moving forward. You just lost a third of your income. Be very careful with product pitches. It doesn't make the instrument wrong. You just can't leave yourself that exposed, especially for longevity reasons. So
Right.
you're getting fancy with low-risk assets and how you're structuring it. Scott, let me know if that resonates or if you got follow-up questions. All right. This next one's with, I love it. Yeah. People, you're welcome, Scott. He says thank you.
All right.
Love it. All right. This next one comes from Mike. If we face hyperinflation, such as the 1930s in Europe, very tough time, what are the safest instruments? So, this is a tricky one. But as a general rule, it's your assets in the market that are going to help hedge against inflation. Think about it. When we printed lots of money because of the pandemic, where did it go? It went to people's pockets. Then where did it go? They spent it. Some of them saved it and invested it, which boosted the stock market. Others spent it. When you spend money, where does it go? It goes to the business. And then the businesses circulate. And because we have basically overemphasized the large companies, it slowly made its way up to the large U.S. companies.
Right. Like your Home Depots and your...
Home Depot was killer.
I remember that. Everybody got that cash and then they did remodeling work, right?
Yeah, GameStop, that wasn't real. That was more hype. But
Right.
But assets in the market is how you hedge against inflation. Assets in fixed accounts, whether it's fixed lifetime income, right, like an annuity or a CD ladder or a MYGA ladder or anything low risk, is what has inflation risk. So in my mind, it's appropriate to blend between market risk, and you've lined up your short-term risks, market risks specifically, that you never take income from an account that's lost money, never lock in those losses. So in the short term, your spending is taken care of by protected accounts, while long term, you're hedging against inflation. You know the yin and yang kind of symbol?
Yeah, I do.
A lot of people think it's paradoxical. They're at odds with each other. It's not right. It's a beautiful harmony of two opposites that are complementing each other.
Yeah.
When I think of paradoxes, one of my favorites is the paradox of speech. You can be frank or you can be diplomatic. If you're all frank, you're blunt,
Yeah.
and people don't necessarily want to talk with you.
Yeah. Yeah.
If you're all diplomatic, you're evasive, you're a politician, people don't really want to talk with you.
Yeah.
But if you can blend being frank and diplomatic, you've got forthright diplomacy. It's a beautiful balance. When you look at financial planning or retirement planning, you need to have a balance of hedging against market risk and hedging against inflation risk. It's a beautiful balance. And too often, we're stuck in that spot of the markets are going to crash, so I'm going to go all against market risk and put myself in all in inflation risk. Or risk means reward. I'm going to put myself all at, I'm going to get rid of inflation risk. I'm now all in market risk. Finance is about balancing paradoxes. Mike, let me know if that resonates. If you got follow-up questions. Oh, Scott likes the analogy of the feeding the fish. Yeah, that was a fun one. All right. Let's see. We got next ones. Do you have any on yours? I know we have two different polls or two different feeds here, but I got a couple more questions that just popped in.
I'm trying to look back to see if maybe we had one from a previous week that we never got to.
While you look, let me do this one.
Yeah.
So I read your Kipling article. Thank you. That was a fun one to write. This was the cash flow versus income. They're different for those who haven't read it yet. Can you give a more specific example of how much difference can that make and how to apply it? So let me give you the homework. Okay. First off, understanding the differences, you're going to look at line 2B on your, so 1040 is your tax return summary, basically. Okay. So if you look for the 1040, look at line 2B, 3A, and 3B.
Okay.
That's going to look at dividends reinvested and interest that's just showing up on there. Total up 2B and 3B. And that's ordinary income that if you're not spending is completely unnecessary.
Right.
So if you're not spending it, why is it there? And could you shift it to a place where it's going to make more sense? That's one example of it. That is income that's not being spent. Therefore, you're getting taxed on it. Okay. Another one is understanding your cash flow, like I talked about earlier in the show. Understanding how to tap into basis. Your basis is what's not taxed, but you can spend. And then laddering the gains and the other parts of it. We're talking $5,000, $10,000, $20,000 a year in potential tax savings when you understand cash flow, the movement of money, which shows up sometimes in your tax form and sometimes not, versus income, which is what shows up on your tax form, whether you spend it or not, and spending, which is what supports your lifestyle. It leaves your accounts in perpetuity. Let me give you an example. Okay. So we did one earlier, 50,000, let's say, from, I'll just pick up where I left off, 50,000 from your IRA assets, plus 20,000 of long-term capital gains. Okay, that's the income that's being calculated for this couple in Arizona. That's 70,000 of taxable income, and the rest was done as free cash flow because it was tax-free, because it was the basis, it was the original investment, not getting taxed on spending it. Okay, 31,000 was roughly 31,500, so in the standard deduction for 2026.
Okay.
Okay, so the federal tax is about 1,800. The Arizona tax in this example, like 1,300. They're paying like 5%, 4 to 5% in their combined effective tax rate.
Oh, yeah.
I would actually change this a little bit. I would increase their IRA distribution to max out the 12% bracket and actually shift then a little bit less from their brokerage funds. If I could structure a plan, and I do this sometimes when the conditions are right, that all of your IRA distributions stay within the 10 to 12% bracket. And if taxes switch, maybe it goes back to the 15% bracket and that's it. But if I could have all of your IRA distributions come from that part, this is, again, cash flow planning. It's the movement of money and controlling how much is income, how much shows up in your tax statement so that you can spend more of your money and pay less in taxes. That's a beautiful thing. People often come and say, hey, when you do IRA to Roth conversions, I'm saying, well, hold on, pump the brakes.
Yeah.
You've already have enough in your brokerage funds, your taxable funds. You've got a good amount already saved in your Roth. Why would we pay 22 to 24% on every dollar, 22 cents on every dollar, 24 cents on every dollar to get it to the Roth when we could line it up and just slowly drain the accounts.
Yeah.
Oh, because taxes are going up. How likely do you think it is that they're going to tax the poor more? And if so, how much more?
Yeah.
Because if we could slowly drain it at a lower tax bracket, and in your situation there wasn't RMD issues, why are you rushing it? Oh, my kids are higher income earners. Okay. That might make sense. How's your health? What's your longevity look like? Do you see how it's controlling the flow of your money versus the how much shows up on your income tax statement versus how much you spend? Those are three different conversations, yet we treat them all the same.
Yeah.
And then the other part too, so let me increase this here real quick. This will be fun. So we're going to do 100,000 coming from your IRA assets. So we're deep into the 12% bracket, but not all the way there. There's a little bit of wiggle room for just other things that come up. A little bit of long-term capital gains, that's fine. Oh, wait, the long-term capital gains totally tax-free. It's still within the 0% tax bracket. We still have about 30,000 or so of additional room. Maybe, just maybe, we sell a few of the other assets. Again, this is cash flow. We're choosing to change the flow. We're selling an asset to have it flow into another asset, reestablish your cost basis so that in the future we can tap into more basis in the future. This is advanced stuff, by the way. But there's a $30,000 portfolio adjustment we could do tax-free to reestablish a higher basis so that in the future we can tap into that and pay less taxes because we have a window right here on the 0% tax. Like, this is what real planning looks like.
Yeah.
I don't know. Like, I've been doing this for over a decade, and the first place I ran the operations for, the first practice, didn't do this. The second place didn't do this. I coached financial advisors across the country for several years as well. They weren't doing this. And I'm going, what in the world? Why don't we do tax advice? Well, we're not CPAs.
Yeah.
You don't need to be a CPA to run a simple tax calculation.
Yeah.
To say, maybe we shouldn't actively manage your taxable account.
Right.
These are opportunities that come from proper financial planning, yet it's often missed. And looking back, people get pissed when they realize the opportunities that were just sitting there. So hopefully that answers your question, Mark. All right, let's keep going.
Yeah.
And put in the chat, we've got maybe a little bit more time for a few others last minute if you want to throw in the chat any last minute questions. This one's I've got from, aside from trying to get the most out of Social Security, what else should I consider when looking at my filing strategy?
So the age old, like, when do I file for Social Security?
Yeah, a lot of people
Timing.
will look at it. How do I, when do I expect to die? And I want to get the most out of Social Security. And that's fine. But like if you're married, that complicates it. Because the surviving spouse is going to get a certain amount. So let me tap into this here real quick.
Okay.
Just pull up my tax calculator here real quick, okay? So let's say you're getting, if you wait till 70, you're going to get 70,000 between the two of your Social Security, okay? I'm going to make this really simple, okay? 70,000, and all you need is 40,000 from your IRA distributions, okay? We're still in Arizona, so 110,000 of total income that's showing up. But if you consider Social Security and how it's taxed, 85% of it's probably going to get taxed in this situation. Not all of it. That's pretty tax efficient.
Yep.
Now hold on. Let's just acknowledge that for a second.
Okay.
85% of a larger number is getting taxed.
Yes. So only 15% not is tax free.
Part of it's tax free.
Yeah.
Okay. Or you could pull it back. Let's say 50,000 earlier. Okay, and I'm going to increase the IRA by 20,000. Okay, so kind of the same spendable portion here, but 50,000 is now, it's still getting taxed mostly at 85%, but it's a smaller amount, which means you've got more tax consequences from other resources because you have to bridge a gap somehow. So sometimes you have to consider, okay, how much tax-free income is going to contribute to the long-term side, because you don't plan to retire and die. You plan to retire and live as long as you can with a healthy life. So if you have longevity, consider a higher benefit is more tax efficient. You can start to drain your IRA assets earlier on, have more control over it, and really focus in on that 10, 12%, maybe a little bit in the 22% bracket, so that you can focus when you hit the IRA or the Social Security age of 70 and hit the IRA assets, maxing the standard deduction and the 10% bracket, or whatever it is in the future, and having a higher Social Security. I mean, we're talking a lot of extra money here because it's more tax efficient. Thousands of dollars. So you want to consider that too. Also, you want to consider if you switch from the married to the single bracket.
Oh yeah, which could happen if a spouse passes away.
When a spouse passes, you get one Social Security benefit. Having that higher benefit is more tax efficient, helps with longevity risk, helps with the surviving spouse risk, and helps with the widow tax. A lot of people don't fully appreciate how difficult that is. Your spending probably won't change that much when your spouse passes. You're going to get pushed into a higher tax bracket because the single tax bracket is much less forgiving than the married bracket.
Yeah, in terms of standard deductions, right?
So if you can plan for a higher benefit for the surviving spouse, you're making the widow tax less difficult to deal with. It's just there are several layers to this that need to be acknowledged. It's not just how do I get the most out of Social Security? That's a factor. You want to look at your longevity. But you need to factor in these other variables so that you can make an informed decision. Sometimes it makes a lot of sense to file earlier on. Typically 64, I think, is the soonest because 62 and 63 have an accelerated reduction of benefits that you're locking in for life. So maybe 64 is the soonest you want to take it. And then you can make decisions 64, 65, 67, 70, split them if you're married. One's at 70, one's at 64. You know, you can do things like that. Hopefully that helps. All right, let's do the next question here. All right, got a rental house with my tenant who moved out before re-renting it. And I'm wondering if it's a good time to sell rental real estate or to move to a less me-involved investment. This is the classic landlord situation.
Yeah.
So everything has a benefit and detriment. Being a landlord, if you have good tenants, they stay in there a long time, great.
Yeah.
If you have bad tenants, they trash the place, that's a detriment that that's a risk you're taking. Just like a dividend can stop paying, just like a stock may stop growing but start declining, rental real estate can stop paying income. That's one of the risks. And
yeah, because you're either a bad tenant or the neighborhood goes south or a whole lot of issues.
So here's the general, and I wrote a book on this, we'll publish it soon, How to Retire from Rentals. First, you need to ask yourself, do you want to be a landlord or not? Do you enjoy the responsibilities? For some people, it's the reason they get out of bed. For others, they couldn't be bothered. It was fun while it lasted, but now it drives them crazy.
Yeah.
Okay. And they don't make appliances like they used to. Appliances need replacing sooner, right?
Isn't that a shame?
Yeah. So affordability is people aren't making as much as they used to. So if people can afford your rent, that's going to put pressure, inflationary pressure against you on what you can charge for rent and so on. So there are those factors. So if you decide, I'm not really sure I want to still be a landlord, you've got three options. One option is sell it and pay the taxes. Now, it's not just the gains. You've probably been depreciating the asset year over year over year. What does that mean? That means you're paying a lot of ordinary income or depreciation recapture tax plus the capital gains tax. That's a hefty tax bill. It might be like 30% or so of whatever the total sale price was that's going to taxes. That's a tough pill to swallow.
Yeah.
Okay. And that's in addition to all your other cash flow movements and income movements on your financial situation. But that is an option. For smaller cost houses or homes, rental real estate, like maybe a little condo here or something there. That might be a viable, townhome that wasn't worth that much. Maybe you just say, I want to get out of it, have complete liquidity and flexibility, and you just pay the tax bill and move on. But for the first person that has a $500,000 home or $1 million home or a duplex worth a lot or a $10 million apartment complex or a shopping mall or a strip mall, those taxes add up real quick. And now you are trapped by taxes because you might struggle to stomach that tax bill and you want to pass it on to your kids because if If you wait, the kids get the step up in basis. It's now you're a slave to your property because you're trying to save some money in taxes for legacy purposes. You're not putting yourself first. Here are your other options. One is you might be able to find a real estate investment trust that will do what's called a 721 UPREIT.
Okay.
They absorb your property and then give you operating partnership units of the REIT, and then you maintain cash flow based on not your property, but the overall REIT, and it's someone else's problem.
You sort of split ownership with them, but they like
You don't
take care of
split.
everything.
They own it.
They own it, and then you just get some shares.
So a REIT is a company,
Okay.
and the company, you now are a part owner of the company, but you're not a controlling partner.
Oh, okay.
You're the guy that, they're going to give you the check and say, now don't bother us. And I'm not trying to be mean. It's like
Yeah.
you call them and say, hey, I think we should do this. They're not probably going to listen to you.
Right.
You're giving up control for the paycheck and to avoid the tax bill. Okay. And that kind of complicates in some ways, and we don't have time to really digest all of it on the estate planning purposes, on how do you liquidate it, what's the liquidity purposes like, when you liquidate if you're alive versus the legacy on how the taxes are handled. But still, that's an easy way to go about it.
Yeah.
Be very careful about these 721 UPREITs because some companies realized what this tax code can do, and they have grown faster than I think they can handle. And if a UPREIT, we'll call it, a REIT, grows too fast and they can't handle all of the properties they're now managing, those properties start to decline. That hurts the income, that hurts. So just be very careful. Do
Right.
the vetting process of this. The other one is a Delaware statutory trust. So instead of being a partial owner of a company, you can do a 1031 exchange to fractional ownership of actual real estate. A lot of people don't know about this one either. Here's how it works. Let's say you take your property, you get rid of it, you sell it, and it goes through a qualified intermediary. You can't touch the money.
Yeah. So the proceeds of the sale don't come to you; they go to that intermediary.
Yep.
Okay.
They have to go to someone else.
Yep.
And then you've got 45 days to select properties that you want, and then 180 days total to be able to get the funds to then those properties. Delaware statutory trusts. But these are institutional grade investments. So think of like an Amazon warehouse or a self-storage unit or a marina or something like that. And you now own like 1 or 2% of that property. So you maintain your cash flow. Many times your cash flow actually can increase. When I say cash flow, I mean income coming in specifically, and you can spend it or reinvest it. That's up to you. But you got money coming in, the asset appreciates in value, and the DST is going to be sold probably in 5 to 7 years. So then you have to get another one, and then another one, and then another one.
Okay.
The joke is that this is the swap until you drop strategy because you defer taxes until you're dead. Kids get the step up in basis, but you're maintaining your cash flow without the responsibilities. Very few advisors understand or even have the relationships to do this.
Right.
It's very specialized. It's one of the things we do here at Kendrick Wealth, but it is not your normal situation. Okay. One red flag, though, these are high commission products.
Oh, these DSTs.
They're going to pay 5 to 7%, sometimes even more, of whatever you put in there. Now, because we don't have the brokerage licenses here, because we are fiduciaries and we cannot accept back-end security commissions, you're paying our planning fee. Sure, it does take work, but we've negotiated that you actually get the commission, not us, because the commission is going to someone. We can't legally accept it, so you might get a bonus too for it. We're not trying to engineer that in any way. We're just saying that we can't take it, so we'll negotiate that you get that.
Yeah.
It's kind of a nice bump,
Yeah.
nice
Absolutely.
bonus. Don't want money to go to waste.
No.
But I say that because some people may push 1 or 2 products because they pay a slightly more or a higher commission. We really don't mind where you go as long as it's the right risk with the right suitability, with the right type of property, and it's something you're comfortable with. We're one of the few that charges a flat fee to do the whole vetting process and to get you from point A to point B. If that's something you want, retireontime.com, click that button. Scott, for you and anyone else, just click the button, talk to a planner, tell us what's going on. We'll dive a little bit deeper, and if it makes sense, we can go through that process. It's good to have a more comprehensive plan with it so you can see all the factors, but some people just want to sell it and move on. Oh, there's a follow-up question. Do the DSTs and 721s and so on keep you out of the cycle of the stock market? Yeah. So
Yeah.
generally speaking, you've got different markets, and here's kind of the different markets as I see them. You've got the cash market, which is heavily influenced by the Fed. You've got the bond market, which is heavily influenced by the Treasury. You've got the stock market, which is the public stock market, right? And then you've got the insurance market, because those are complex instruments that operate, they're their own thing. Then you've also got the alternative market. So think private equity, private credit, collectibles, it's like the random market. And then you've got the real estate market. They're like in 2001 and 02 when the stock market was just tanking. Bond market was fine. The real estate market soared.
Oh, right.
So what I can't say is that when the stock market goes down, the real estate market goes up. That would be a inverse correlation. It's not that way. It's that they're independent markets.
Yeah. So if one goes down, the other one doesn't go with it. They're
It's
independent.
just, sometimes they'll both go up at the same time. Sometimes they'll both go down at the same times. Sometimes they'll be the opposite of each other. They're independent markets. So, and when people say, well, the stock bond market, they rhyme, kind of,
Okay.
but not always. Like 2022, they both went down together. So they're independently correlated. That's how you diversify by markets, which is another way of saying diversify by strategies.
Okay.
Different tools in the toolbox that do different things. That's a great way to go about it. You don't want to just buy a bunch of the same thing over and over again. That doesn't really help. But when you understand the different strategies, the different tools in the toolbox, that's when it can help. Be very deliberate about it. So that's all the time we have got, though, for today. Hopefully you enjoyed the show. If you want to schedule a call, retireontime.com/call. That's how you get there, or retireontime.com. Click Talk to the Planner. 30-minute call. Tell us what you want your retirement to look like. Tell us what you want from a financial professional, and we will proceed as such. If you decide to proceed in our planning process, the first 2 appointments are free. Not going to charge you, so you can get an idea of what the planning process actually looks like. After that, it's up for you on how you want to decide to proceed. As always, we've got these shows live Tuesdays. Weekends are on the radio stations as well. We air it on YouTube or repost it on YouTube and our podcasts on the weekends. Thanks for all being here. Appreciate the time. We'll see you next week, same time, same place.